my first question is, of course, about elevator.
Gladly, yes. I mean, I'll put it very simply. We are the corporate VC of Raiffeisen Bank. We've been around since 2019. Basically, the fund is now at its second edition. So we have had the first vintage. The first fund was a 50 million euros fund. Did 15 investments out of that, 5 exits already, 10 good companies still doing well. And in the second fund, the second vintage, we started it last year. We are already underway in the second year of investment, signed already 6 investments, about to do the 7th. As a fund, as a CVC, we look at, of course, being the CVC of a bank, financial technology, let's say, is core to our mandate, but we look at a lot of the adjacent sectors. So that means cybersecurity, that means B2B software for infrastructural software, particularly a bit deeper tech on data and data analytics. And we're even open to energy, and we do actively look for energy. Again, in a way, energy software could overlap with financial solutions. We're an early stage investor. We do tickets between 1 to 3 million euros. These are the initial tickets. And we look at Central and Eastern Europe as our main area. So generally, that means European startups, particularly also those with plans to CEE as well.
Now that you laid out all the PR stuff,
Yes.
we can get more into specifics like this.
Please.
So you said that you invest in Central and Eastern Europe, and also your core is fintech.
Yes.
What are you seeing here in Central Eastern Europe? Because of course we are always hearing about the US unicorns or like the sorts of like Klarnas of the world. And here in Eastern Europe it's a bit different. I can say this also because I used to work back in the day at fintech, a mobile app. You probably know Pago. And I'm seeing that it's a bit of like bootstrapping here with fintechs.
I mean, listen, bootstrapping is probably a sound strategy anyway in any sector, in any place to start. But aside from the fundraising strategy, of course, there is a challenge in CEE when it comes to funding. But there is, of course, a challenge of market fragmentation. That's a reality. So I think a lot has been said and done about this, so probably no point in drilling a lot about it. But we know that a lot of great founders who come from CEE also ended up landing in Western Europe, in the US, and other markets. And that, again, means that those particular founders could have a bit of an advantage when they go to their home market, in addition to the traditional, or let's say the more lucrative growth markets that they are already in. Yeah, if you are a Romanian founder in London, you will probably go after the UK market anyway. And if you are successful, you will probably want to go to the US or North America and maybe even Western Europe. But as a part of your success, you will probably also look a bit more homewards, at least for some back office, so potentially some OPEX, some R&D, some cost centers. But that also could and usually means some sales activity and some account management and some even market penetration. That will not be the main driver of your growth. That's a fact. Again, if you want to compare GDPs, if you want to compare ease of doing business, then of course any successful founder wants to seek the highest growth, the most, let's say, frictionless or the least friction in the markets. And that's could be a combination of where they are, wherever they are. They are in Germany, they are in Switzerland, they are in the UK, and CEE. So that's still a good enough business potential. And that's actually a good way of looking at business that doesn't discount existing founders from CEE. Founders who start in CEE always have, of course, thicker skin because it's a tougher market. And that also could mean that they are much more resilient and they are more capable in expanding once they have hit some of their initial milestones. Both very attractive for us.
Sure. You've talked earlier about like being an Eastern European founder in London and having the UK market as a core market, but I know that here in Eastern Europe, like the markets also needs like some disruption in the fintech sector. And there's also fragmentation in regulation.
Of course.
And I want to talk more about this. And of course, we don't have a Chatham House rule here.
Of
But
course.
I think that we should tell it like it is, and please tell me like it is here. Like, is this fragmentation in market like really like stopping innovation here in Eastern Europe, like in the Eastern European markets?
I mean, for sure, yeah. If you look at open banking, just take that as a good example. Yeah, open banking was a big promise made for everyone. PSD2 was something that everyone was looking at. Where are we today after so many years from PSD2?
Maybe we are waiting for PSD 3.
There is, of course, and again, more promises will be made. I'm not saying there
Then
weren't.
the fourth one will come.
Of course, and you will see more of that. Yeah, the thing is, regulation is always, of course, a good driver, a good instigator, not necessarily the best driver. Market-driven needs and market-driven growth is usually best, but that obviously means there are many parties involved here. Yeah, if you want to come and say, okay, the Central Bank of Romania, the National Bank of Romania, did not do licensing so quickly. If you also listen to them, you will also understand that they have way too many controls to worry about than just innovation. So they also do have a point. Innovation in of itself is not good or bad. It's not in isolation of the market. Yeah? So if you want to think about a market, there is monetary policy, there is fiscal policy, there are market dynamics, there are existing players, you cannot just offer unfair advantage also to startups because that doesn't, and vice versa. Yeah? You shouldn't maybe offer unfair advantage to incumbents. That said, is fintech challenged? Of course, but fintech, listen, financial technology came with a lot of promises. Yeah, ease of doing business, faster, more accurate. You always hear that. Now we heard about it in lending and in payments, and we heard about it in other areas. Yeah, so in RegTech as well. Yeah, so you can look at RegTech as a part of fintech, and we have seen some of it materialize, but not all of it. Meaning, underwriting, did it become faster? Yes. Did it become more accurate? Not necessarily. Yeah. So, payments, faster? Sure. More convenient? Amazing. But it's commoditized. It's not. It could be a growth. It could be a great story, but there are big incumbents.
If I ever hear about the payments app for kids, I will.
See, you are already laughing. That's true. Education, financial education. It's an edtech anyway. It's not even a fintech, but a lot of them were pitched as fintechs. What I'm trying to say is, we as a fund also have noticed that. We have done it. We went a bit niche in lending, so we did agri-finance, and that was thankfully quite successful for some time, and it did well. We did what we can call technologies around financial technology. So again, Sesam, one of our companies, data analytics company, mostly for qualitative and quantitative risk, but mostly qualitative risk, sentiment analysis, and so on. And we have done also adjacent, like prop tech, logistics, and so on. So there is still something to be disrupted, sure, but how much more can you disrupt? And here, again, we go back just to the value propositions. Speed, quality, and obviously if that leads to cheaper or at least more efficient or even more profitable, that's also good. So top line or bottom line effect, that's good. But in financial technology, probably a lot has been already said and done. So that's why also in Fund 2, as I mentioned, cybersecurity is something we look at. We are looking also at a lot of the energy software, because we think a lot of the energy software companies always have a financial angle, which is either pricing, forecasting, trading, invoicing smaller, invoicing bigger, So filling the value chain, the data of energy software can contribute effectively to the value chain of energy. Yeah. So the value chain, that is the financial value chain or the financial components of it. Is this sufficient? Is this fintech? I don't know. We are not here to define the sectors. We are not. We're not a research institute.
Yeah, there was like a time when fintech was all the hype with Revolut, right? I'm seeing, but I'm not seeing that much with Klarna now, right?
Yes, you're right.
It started to look cool again, right? Fintech. But is it like actually like really innovating and doing like disruption, or just naming something in some other way and putting a bow on it?
I mean, In some cases, yes, you're right. It was lipstick on a pig. It wasn't really different. In some others, there was true disruption. You know, it's some of the neobanks and some of the very successful neobanks. True, the onboarding experience is completely revolutionized now. You also take that even to the risk management. Some of them, especially the successful ones, they've done really a great job in minimizing the cost of risk and minimizing the cost of the risk analysis. That was great because they had to transform into banks and they were digital and they were heavily challenged on that. Some of them succeeded. But again, what do you disrupt more now than that? You know, again, lending, for example, a lot of people were promising that data will help us lend better. Well, everyone saw the first prospectus of Klarna, yeah? The default rates, the delinquency rates. Let's say they showed a picture which is only way true for consumer lending and have always been true. Consumer lending is hard and risky, and probably data-driven lending was not bad, but data-driven lending maybe did not bring the disruption everyone wanted, yeah? So maybe it was marginal and in some cases maybe good, but that was specific to some markets, specific to some age groups, specific to some purchases. Overall, it still went back to still risky, delinquency rate is high, default is high. And again, looking at the prospectus of the biggest, let's say, player, yeah, in buy now, pay later, for example. This was, buy now, pay later in of itself, I would say, was of course nice, and there are many definitions that say buy now, pay later is buy now, pay later, but it's consumer lending, yeah? So, I mean, you want to look at it truly, it's consumer lending. It did not, changing the name did not change the nature of the underlying risk.
And the problems.
And the problems, absolutely. And that did not change much with technology. It was easier to lend you. It was easier to lend me. It was easier at checkout. And that definitely has value. Is that value disruptive? Does it open the market massively? Well, still a lender has to worry very much about risk management, capital, you know, availability, cash flows. That did not change. And that did not change from the time of medieval banks to the time of digital banks. Maybe it became faster, more technology driven. It's still something to worry about.
And now one of my last questions, like second to last, is about, I'm going again into regulation.
Please.
Sorry for this one.
Not the expert, but happy to share what we know.
Yeah, but also because I have a fintech background when I used to do marketing. And our growth plan was like taking maybe country by country, like more sort of like bootstrapping. And because there are different regulations in every country.
Yes.
So there's so much you can disrupt in some, so much that you can disrupt in others. Will a pan-European entity, the one that UE Inc. petition is like petitioning, will solve this, or it will create much more hassle because you will need to bridge the financial regulations with all the commercial now regulations that sort of like trying to be one across Europe?
What do you mean by a pan-European entity, just to clarify? What kind of entity is pan-European in this case?
I'm thinking about the 28th regime from Andreas Klinger, the petition EU Inc., like to have, to sort of like also have a Delaware corporation here in Europe.
Got you, yes. Again, it's all, listen, these are things that are market driven, yeah? So you can make all the regulations you want. And Europe, at least for some part,
We have lots of regulations.
Yes, Europe has always promoted itself as the home of regulation, and that is a part of the value proposition, which in many cases was good, maybe useful, but in some others maybe it wasn't. Yeah, and it was at least a lot of that was put on the shelf or not exactly implemented well. This is why, again, you need trust. Trust is the main engine of a pan-European regulation or setup or trust. Why do people go to Delaware? Because Delaware have been tried and proven over decades of operations on all levels. Incorporation, dispute management, attracting investors, taxes, tax code. You know, at the end of the day, investors aren't founders. They are there to make money. If the tax code requires let's say, new knowledge to the existing tax authorities. Nothing against any tax authority, but tax authorities are people that work by the book, because it is a book, it's literally a book. They have to follow it. And a new tax regulation opens room for interpretation, opens room, and that's one angle. So, as an investor, as a founder, would I want to try a new regime, a new tax regime with the old tax authorities, or can I go to the tried and proven tax systems? Yeah, so I can go to, for example, in Europe you have the Dutch, the Netherlands, you have the Luxembourg, of course, and there is, of course, the Swiss, and the Switzerland itself are known. These are three jurisdictions, and maybe among others, but these are the ones I'm familiar with, that have always promoted, there is an ecosystem, a bunch of advisors, tax authorities are active. They know the tax code is evolving constantly.
Or the interpretation of that tax code.
The interpretation of the tax code. And that's one, I'm taking one angle as an example, but the context is broader. There is dispute management, arbitration, how do you do it? Contracts. To this day, some European countries require you, we were laughing about it yesterday, some of the countries require not just a notarization, but at the notary, you have to sit and hear the readout of the shareholders agreement. So, and that takes you 3-4 hours. That of course cost, but besides the cost, the concept, this is all the asset classes in the eyes of those laws and legal regulations are the same. Whether you're buying land, apartment, a car, or shares in a startup, it's the same. And it's not the same, you know what I mean? And you go to the Netherlands, you go maybe to Ireland, you go to some places, they already started distinguishing, they've built the ecosystem, and it was a deliberate, patient build-up. Could Europe do this? Sure. But if they expect results in 1 year, 2, even 5, this will probably not happen, because you need multiple cycles of establishing trust in every segment of the system. The tax code, the arbitration, the attractiveness to investors, the, let's say, money in, money out possibility. You know, Dubai has been promoting itself as a great destination. Probably it is in some areas. And people started trusting it once they've put their money in and they took it out. And they made money, even when they lost money. But they still managed to take it out. Yeah, there was movement, and it was almost hassle-free. And that applies to some other countries who did this. But this is deliberate and takes time, years, measured in years. So, to your question, could it happen? Of course. Does it take time? A lot. Would it be successful? Well, yeah, it depends on how it will be implemented and how much trust does it inspire in the market, considering that there are alternatives. This is not in a void. If I am a founder, I can go to Delaware. Yeah. If I'm an investor, I can demand that you go and incorporate somewhere that's easier for me.
That's actually a nice summary to our conversation. And hopefully on that note, we'll see more innovation in the fintech sector.
I hope so as well.
Hopefully, on that note.
Yes.
Thank you.
So
Bye.
much. Thank you.